you've been saving for years, contributing consistently, watching the balance grow slowly, methodically, and then one day, you check your portfolio and the number crosses a line you've never seen before. $500,000. It's not a million, not yet, but something about this number feels different. The weight of it registers differently in your mind. You think about it differently. You make decisions differently. And you're not imagining things. There is a genuine psychological and mathematical shift that occurs when an investor crosses the $500,000 threshold, a shift that changes how you relate to money, to risk, and to your own future. To understand why $500,000 feels different, we have to first understand how the human brain processes large numbers. We are not naturally equipped to comprehend exponential growth or abstract wealth. $100,000 feels like a lot of money, but it's still within the realm of things you can visualize. A nice house, a decade of salary, something tangible. $1 million feels abstract, almost mythical, a number you hear about but never expect to see. 500,000 sits exactly in the middle, and that position activates something unique in our psychology. It is the threshold where money stops being about what you can buy and starts being about what you can become. This is the wealth threshold where financial independence becomes mathematically visible. At 500,000, using the traditional 4% rule, your portfolio can generate $20,000 per year in passive income. That is not enough to retire on for most people, but it is enough to cover basic expenses in many parts of the world. It is enough to change your relationship with work. It is enough to start thinking in terms of options rather than obligations. The number itself has not changed your life yet, but the possibilities it represents have begun to reshape your psychology. There is also a mathematical acceleration that becomes noticeable at this level. Market movements that once felt insignificant now register in meaningful dollar amounts. A 10% correction when you have $50,000 is a $5,000 loss. Uncomfortable, but manageable. A 10% correction when you have $500,000 is a $50,000 loss. That is a year's salary for many households, disappearing and reappearing with the daily fluctuations of the market. Your brain cannot help but pay attention differently when the stakes are higher. The emotional voltage of every market move increases because the dollar amounts attached to those percentage changes have crossed a threshold into genuine consequence. But the psychological shift runs deeper than simple math. $500,000 is the point where the accumulation phase begins to feel like it has momentum. The early years of investing are a grind. You contribute money, the market moves slowly, and the growth feels like it comes entirely from your own effort. But somewhere around the $500,000 mark, the market's movements begin to rival or exceed your contributions in terms of impact on your net worth. A good year in the market adds more to your portfolio than a year of diligent saving. This is the moment when compounding transitions from an abstract concept into a felt experience. You stop feeling like you are building wealth through effort alone and start feeling like your money is working alongside you. This shift in perception carries risks as well. The same psychological mechanisms that make 500,000 feel empowering can also make it feel fragile. Investors who struggled to stay calm during corrections when they had $50,000 often find it even harder when they have 500,000. The fear of losing what you have built can become paralyzing. The desire to protect can override the logic of staying invested. This is why understanding the psychology of wealth thresholds is not just an academic exercise. It is essential to preserving the wealth you have worked so hard to build. Historically, this threshold has marked a dividing line in investor behavior. Data from brokerage firms consistently shows that accounts crossing the $500,000 mark tend to exhibit different trading patterns than smaller accounts. There is a tendency toward conservatism, a desire to lock in gains, a temptation to shift from growth to income. And while some of that shift is rational, much of it is emotional. The fear of falling back below the threshold can be as powerful as the ambition to push past it. You have to recognize that impulse for what it is, a psychological reaction to crossing a line you have visualized for years, not a rational adjustment to your actual financial goals. There is also a social dimension to this threshold. $500,000 is the point where wealth becomes visible to others in a new way. Not because you drive a different car or live in a different house, but because the internal freedom it provides begins to shape your external decisions. You say no to projects you would have said yes to before. You take time off without panic. You invest in experiences rather than things. And people around you notice the shift even if they cannot name its source. The confidence that comes from knowing you have a cushion, a growing asset base, a future that is not entirely dependent on your next paycheck, changes how you move through the world. The math behind this threshold is straightforward but worth internalizing. At a 7% real rate of return, $500,000 grows to $1 million in approximately 10 years without any additional contributions. That means the second $500,000 takes less time and less effort than the first $500,000. The compounding curve steepens. The progress becomes visible in larger and larger increments, and the psychological experience of watching your wealth accelerate is fundamentally different from the experience of grinding through the early years. You are no longer climbing a hill. You are riding a wave. But none of this happens automatically. The psychology of the $500,000 threshold can work for you or against you depending on how aware you are of its influence. If you understand that the fear and excitement you feel are natural responses to crossing a meaningful line, you can make decisions based on logic rather than emotion. You can recognize that the market's movements feel bigger because the dollar amounts are bigger, not because the underlying risk has changed. You can resist the urge to protect what you have by abandoning the strategy that helped you build it in the first place. $500,000 feels different because it is different. It is the point where wealth becomes self-reinforcing. It is the threshold where compounding becomes visible. It is the line where financial independence transitions from a distant dream into a mathematical probability. And if you can navigate the psychological shift that comes with crossing it, you will find that the next $500,000 arrives faster, feels steadier, and changes your life in ways you are only beginning to imagine.